Well, with the current focus on the performance of the US core capital goods and US payrolls, investors are increasingly seeking alternative opportunities for investment, such as the general housing market. Eugene Goosen, portfolio manager at Aura Fund Managers, joins us in studio to share his insight. And Eugene, on the back of the US core capital goods orders that came out last week, can you give us your take on the US macroeconomic environment and obviously how that ties in with the health of the US consumer, which accounts for about 70% of overall US GDP?
Yeah, the US consumer is very important in our lives, and you know, we anchor two thoughts for the guys there. Their balance sheet is mainly driven by property and equities, and equities have done reasonably well over the past year. Properties, we believe, are stabilizing. Now, the numbers that we saw last week, if we look at durable good orders and then specifically broken down to capital goods, it's fairly volatile series, but it's quite important because it gives us a sense of the capital investment in the US economy that is occurring and what we can expect then going forward. There's a good correlation between core capital goods and employment numbers. And what we would like to see is that capital investment momentum gathers slowly. It's not something that is going to explode. We just want guys to be investing a little bit more, creating a little bit more capacity, because we have a chicken and egg story. The more capacity you create and capital you invest, the more jobs you're going to create. Although from a housing perspective, we really believe that the housing market is going to drive the first real spur of employment growth over the next year or so, because the whole industry has been knocked to such an extent.
Hi, Eugene, this is Viv Governdy here. Yes, those numbers are quite deceptive last week. The durable goods came a little higher than expected. But once you factor in the fact that Qantas just, I think, cancelled an $8.5 billion buy from Boeing for airplanes, I mean, that number would have come down quite significantly. And we're also seeing certain alterations in terms of, for instance, miners' expansion plans. Obviously, looking at capital good formation, what impact do you think it's going to have in the future?
Yeah, well, firstly, when you look at those numbers, you've got to strip defense and aircraft out of the numbers. It just makes it way too volatile. So you look at the real core series, and then even that core series is still reasonably volatile. What will drive it forward is exactly what I said. It's capital expenditure. So we want to see the nitty-gritty manufacturing part of the States, which isn't a substantial, it's 25 or 30% of the US economy. We want to see the capital investment gather momentum. Capital investment, in other words, the auto industry do a little bit more refitting and produce a little bit more aggressively, open up a little bit more capacity. That will give you a sort of a pivotal gap in the economic expansion of the States. On the services side, things is humming okay-ish, but it's not going to create any magic solution to the US economy. We believe the momentum driver on the job side will still come from the housing side, but it still links into capital investment, in capital expenditure. So if we look at GDP growth, fixed investment, capital expenditure over the next year or so is going to be a very important component. And we don't believe consumer or plain direct consumption is going to be, personal consumption is going to be such a big deal.
Eugene, I want to take it now to Europe. I think we may as well do a survey of the health of all the different territories globally. Your thoughts on Europe and whether we're going to come through this plain sailing or we're in for tough times and contagion across the board?
Tough times for quite a long time. I think we know what's the problem. We know what's the solution. We're seeing how they're patching the solution. It's slowly gathering momentum. It's going to be very important, the Constitutional Court verdict in Germany in September and the way forward. But in general, the market is fairly positive about it. So I think the problems in Europe is in the price. I don't think there should given what is being applied, the medicine being applied currently, should stabilize things. It's not going to solve the problem. This problem is going to take years to solve. What is important is that we don't see substantial GDP shrinkage in Europe. If it shrinks for another 0.25%, 0.5%, it's fine. You just don't want to see it plunging. The core issue currently, I believe, in global GDP growth is balance between what's happening in the US, extremely important, and then how Asia, and more specifically China, is adapting to that.
Hi, Eugene. Viv here again. Speaking of Europe, you said that the solution is known. Can you give me an idea what you believe the solution is for Europe? What are the end game? What's the end game, basically?
Well, I think the end game has got 2 or 3 core steps to it. The first step is that the sovereign expenditure, specifically in funding expenditure, needs to be forced down. In other words, they've got to lean on the sovereign yield curves, which will make balancing the budget a little bit easier. On the normal expenditure side, they need the austerity. They don't have a choice. I mean, if I spend too much money, borrow too much money, one way or another, you either got to go bang or you pay it off. And I think they prefer to pay it off. So the yield curves needs to be leaned on. The only way that you can achieve that is that the central bank, the European Central Bank, start doing some sort of asset purchasing, even if it's a QE, or alternatively simply funding these weak sovereigns. The only way to achieve that is that everyone buys into the game, and especially the Germans.
Eugene, are you concerned?
At the end of the day, the Germans will have to bail the European Union out. There's no doubt about that.
Just to set the scene for our resource discussion in a moment, the iron ore price is pulling down or under pressure close to $100 a ton. Are you concerned about this?
Yes, I am. I'm a little bit concerned. I think the Chinese economy is surprising on the downside more and more. It's a little bit worrying, but I won't be surprised if they're playing the game. In other words, the inventory levels is very low. If we correlate the iron ore price with metal prices in the States and in China, we can see why it's coming down. But I think it's pushing into territory that is a little bit excessive. It will most probably stabilize over the next 3 to 6 months, and I would guess maybe not at $100, maybe a little bit higher. But I don't think we should expect magic. It's still a very profitable business at $100 a ton. Depends where it's sourced, but from a South African point of view. But the Chinese economy in general is making me a little bit worried. I think it's slowing down a little bit more than I would have liked to see. And we are not seeing any substantial support from their side. We're not seeing any monetary stimulus. Their property market looks a little bit weak. So I'm a little bit worried there.
I want to focus what we have left of the discussion on the local environment and what you're seeing in terms of sectoral earnings revisions, perhaps just starting with the warning out there that we could potentially see some retailers coming in with earnings downgrades. And of course, that doesn't augur well for these heady share price levels.
Yeah. I think the retailers is excessively expensive, and to justify these kind of P's, you need substantial earnings growth. I mean, you need earnings growth in excess of 20% per annum, I believe, at these kind of price earnings multiples. And what we just saw over the past week or two being reported is not bad, but it's just way too slow to justify these kind of earnings. Now, on the resources side, we saw the earnings revisions coming down as commodity prices start bottoming out. On the financial and industrial side, we haven't really seen this earnings revision on the downside, maybe on the construction side, but in general, it's been behaving on an index basis very well. And I'm really worried about the retailers and to some extent some of the consumer staples as well. That we are just not seeing growth to justify the P. So what we are seeing currently is that analysts are reviewing their positions. We are seeing that earnings is going to be still quite acceptable, but not as good as we expected. And the share price follows earnings, whether you like it or not. If the earnings are revised down, the share price will flutter along. So I'm a little bit worried about that.
Eugene, a little off topic. I mean, we talked about the things that ran, but let's talk about something that fell quite dramatically. What's your view in the construction sector? Is there ever going to be a time to get into this thing?
I think there's was a very good comment today in the market. I think there's capitulation on the construction sector. I mean, it's just like the platinum sector. It's just getting shot out more and more and more, and eventually people give up hope. They stand back and they just cut their losses. I think one's got to be very careful. Valuations is attractive. I mean, some of these shares are trading at tangible NAV. One's got to be very careful that you need companies with strong balance sheets in that environment. But if you look at what is happening in the country, we in a very emotional state over the past month or so, and we're most going to be in a very similar state over the next 3 to 6 months. But on the back of that, there's a lot of construction work that will have to be done, whether you like it or not. And how it's going to materialize, we don't know. We know what the planning is. So I think linked to the platinum sector, I think the construction sector is just getting more and more attractive. But you know, further down the line, you've got to stomach drawdowns and just hope for recoveries over the long term, because this is not a market where you're going to time it.
And Eugene, on a more macro level, we've seen inflation rates coming a bit lower than expected recently. What would it take for you to, I don't know what your assumptions are right now, but I think most people believe that we're not going to see a rate cut in the near term. What do you think it will take to see a rate cut in South Africa before the end of the year? Another one anyway.
Okay, so my take on the macro economy, you've got to look at it from a cash flow point of view. In other words, what is taking cash out of the consumer or the spending market's pockets, and what is putting cash into their pockets. Inflation coming down, we've got to be very careful. We've got to look at the electricity prices and the second round effects. Now, you've got to be careful. Interest or monetary management is not going to help these administered prices, or administered prices shouldn't impact monetary management because it's simply cost push. However, you've got to be very careful on the food inflation side. We are seeing, if you look at the retailer reports that came through over the past week, it's not substantial, but we're seeing more and more pressure on the food side. That is worrying me a little bit. Are we going to see interest rate cuts further down the line? I don't know. I think there is a possibility. I think probability of a hike over the next year is very small. 20% a cut, maybe 30%, and I think the balance is for stay stable 12 to 18 months. But I don't think you should underestimate the SARB aggression. They're very dovish on growth currently, and if we see a little bit more bad news from Asia, followed through by Europe, then it will impact on South Africa. And you know, if we see weaker commodity prices, then that might be not a bad option.